Let us look at every single financial trap you will encounter on the road to building wealth and exactly how to avoid them. Starting with the very first point, which is overconcentration. This is also known as holding too much of a single asset, and it is usually defined as any single stock or investment taking up more than 10% of your total portfolio. So, if your portfolio is worth $100,000 and you have $50,000 sitting in Google stock, that is probably not the best idea you have ever had. Doing this is essentially the equivalent of putting all your chips on a single outcome, making your future financial stability entirely dependent on the performance of one company. Just look at the example of Intel back in the day, and you can understand the massive potential risk hidden in this practice of overconcentrating in a single stock. At the peak of the dot-com bubble, Intel shares reached $65. Even now, with the massive artificial intelligence boom, it still has not climbed back to its historical high from the year 2000. While the S&P 500 has grown by 5 times, the core goal of our investing should be the pursuit of long-term, stable, and continuous returns. Overconcentration is actually a massive trap. You might not only jeopardize those consistent gains, but you might also develop an emotional attachment to that single holding. This is the exact opposite of rational, objective investing. Most portfolio managers and financial advisors want to see that no single stock exceeds 5% to 10% of your total investment portfolio. So go look at your holdings and tell me if you are also overconcentrated after discussing issues at the investment level. Let us examine your spending habits. The second trap we need to talk about today is lifestyle inflation. To put it simply, as your personal income steadily increases, your daily expenses often follow suit without you even noticing it. Look at this shocking statistical chart from Goldman Sachs. It visually demonstrates the proportion of employees living paycheck to paycheck across different classes. Among people earning less than $50,000 a year, a staggering 57% are literal paycheck to paycheck workers. But what is even more incredible is the higher income groups, among those earning over $300,000 a year. 41% say they are also living paycheck to paycheck. And for those earning over $50,000, which is a full $500,000 a year, even more surprisingly, 40% of them are also living paycheck to paycheck, which is something you should definitely be wary of. The core key to achieving real wealth accumulation is to maintain a relatively simple lifestyle, even when your income grows significantly. As explored deeply in the classic book The Millionaire Next Door, the most successful wealthy individuals do not easily change their original consumption habits, even when faced with a surge in income. If you become too obsessed with pursuing material enjoyment, you will eventually end up ignoring the things in life that are truly important and more valuable. This is why I believe true satisfaction often comes from meaningful experiences rather than the accumulation of physical goods. When you focus your attention on exploring new places, learning new skills, or just spending high-quality time with loved ones, you create lasting memories and personal growth that, in my view, no object can provide. So whenever you get a raise or a promotion and your income increases, you might be tempted to show off that money through your lifestyle. But for your own good, I would say try not to get involved in this comparison game. The third trap today is tax inefficiency. I know taxes are probably the last topic you want to hear about today, but taxes are likely your single largest expense. More than your rent, more than your car, and more than anything else you spend money on. You need a strategic plan for taxes, because if you do not, you are truly losing a massive amount of money for nothing. The most common mistake I see is people failing to utilize tax loss harvesting, putting investments in the wrong accounts, and underestimating the capital gains tax they actually need to pay when selling positions. Regarding putting investments in the wrong accounts, a situation I frequently see is people putting high dividend stocks into taxable brokerage accounts instead of tax-advantaged accounts, like a Roth IRA or a traditional IRA. When you choose the former, you actually need to pay taxes every single time you receive a dividend. This is simply an inefficient practice. There are some proactive methods that can help you reduce your tax liability. For example, maxing out your 401k account, your IRA account, and even your HSA health savings account. If you hold stocks, you might want to consider holding them for more than a year to qualify for long-term capital gains tax rates. Finally, learn about tax loss harvesting. Because strategically selling losing positions to offset realized gains can actually reduce a significant portion of your tax bill, especially at the end of the year. The tax office will always take a piece of your earnings, and your job is to ensure you do not pay a penny more than necessary. This same logic applies to debt management, which leads to the fourth trap, which is giving up on massive refinancing opportunities due to laziness. Usually, if mortgage rates drop by 1%, refinancing makes a lot of sense. Suppose you have a $400,000 mortgage on a $500,000 house, and your current mortgage rate is 7%. If you refinance at a 6% rate, Your monthly payment will drop from $2,661 to $2,398. That is about $263. You can save every single month. However, usually refinancing does cost some money, roughly 2% to 3% of your total loan amount. So on a $400,000 loan, you might pay about $8,000 to $12,000 in refinancing fees if the fee is $10,000. It would take about 38 months to recoup the cost through monthly savings. So the key point is, how long do you plan to live there? If you plan to live there for a lifetime, or at least more than 5 to 7 years, then lowering the rate by 1% is a very good deal. If you plan to move within a year or two, refinancing is not worth it. I believe this trap is relevant to anyone carrying high interest rates, whether it is your mortgage or your car loan. If you locked in a mortgage or a loan in 2023 or 2024 when rates were at their peak, it is probably worth doing the math. Now, if you want a more intuitive way to compare mortgage quotes from different banks, I will leave a link to a free tool from Bankrate in the description below so you can look into the latest market conditions anytime. The fifth trap might surprise you because it is not about money at all, but about your precious time that you can never get back. Many people make the mistake of overworking while accumulating wealth. This is not just a financial trap, but a universal trap that affects your overall happiness from a financial perspective. As your net worth grows, the value of your time will begin to exponentially exceed manual labor. So, I will give an extreme example of time value here, so please be patient. Suppose you have $5,000,000 in your portfolio, and you get a conservative return of 5% a year. That is $250,000 your money earns for you every year. From the portfolio alone, you are pulling in $684 every single day. So at what point does the reward for working an extra hour begin to diminish compared to the gains your capital has already brought you? This is a question you need to keep asking yourself. However, what I notice is that people who are successful in their careers are often workaholics. Even if they have earned enough money to live a full life, even if they have enough to retire early, they continue to overwork. In fact, the most common regret at the end of life is spending all your time working and never truly enjoying life. Struggle is important, but if your net worth and income are growing, maybe you should take a good look at your work intensity. Do not wait until you are 65 and gray-haired to regret it. The sixth trap is the blind confidence brought by early success. If you achieve some success early in life, you must be wary of ego, otherwise it will ruin you. For example, I have a friend who likes to invest all his capital in only 10 stocks. Just 10 stocks already falls into the trap of overconcentration, but it also comes with extremely high risk. However, that is exactly what he wanted. What he pursued was high risk and high reward. And this strategy really worked in 2023 and 2024. Those 10 stocks he picked performed very well in those 2 years. He picked 8 good ones and 2 bad ones. And the overall performance was still great. So after this, he suddenly became very arrogant, even defiant, and suddenly felt he was the greatest investor of all time. So what did he do? Unfortunately, this person not only doubled down, but started taking on more and more risk. Those 10 stocks in his portfolio, he decided to concentrate even further, reducing them to just 5. He would even buy call options on earnings days and occasionally trade on margin. And I recently heard from this friend that just this year, his portfolio has lost more than 30%, while the SP 500 has only dropped about 2%. However, the brutal truth is that just a few years of good luck does not prove you are an investment master. The longer you maintain this false confidence in a bull market, the deeper the pain will be when the market truly begins a sharp correction. Statistics show that up to 90% of day traders end up losing money. Stop day trading. The seventh trap is the overcomplication of financial management. As your wealth grows, various investments often become extremely scattered and disorganized due to a lack of unified planning, making them difficult to manage. People will have multiple brokerage accounts, multiple bank accounts, angel investments, private equity investments, and maybe even some real estate partnerships. According to an article published by DIY Investor, while more than 80% of high earners feel confident about investment decisions involving six-figure amounts, nearly 1/3 admit they are just pretending to understand, and only half understand major investments. The CEO of the UK wealth management platform Sidekick also pointed out that when a portfolio reaches a certain size, suddenly the asset structure, risks, and fees become much more important than before. Financial complexity creates many cognitive blind spots, making it easy to ignore hidden fees or seriously misjudge risks. If your assets and income have grown to the point where managing finances becomes difficult, maybe it is time to consult a professional financial advisor to create a tailored strategy for you. The eighth trap is a lack of liquidity, the so-called asset-rich and cash-poor situation. This means most of your wealth is tied up in assets that are difficult to liquidate. For example, if you put all your net worth into real estate, you are wealthy on paper, but when faced with a new opportunity, you cannot sell a house and get cash within 7 days. Wealth management expert Ben Carlson points out that today millionaires have very little liquid cash in the $1 million range. Families with assets between $1 million and $2 million mostly lack liquidity in their wealth data. From 2023 shows that about 66% of their wealth is tied up in housing and retirement accounts. A general rule of thumb is to always keep at least 3 to 6 months of living expenses in liquid cash. I would even feel that if you are the type of person whose net worth is growing and you have high income and low expenses, keeping a bit more cash flow or liquid funds on hand is definitely a good thing in case a great investment opportunity suddenly appears. In addition, when you go to buy assets that will tie up your funds, you need to consider how long this money will lose liquidity. If you do not mind it being tied up for a while, then I think it is basically fine. I think a mistake people are more likely to make is putting money into places they might need it in the future, and when they actually need the money urgently, they find themselves completely stuck. This is the trap we want to avoid at all costs. The ninth trap today is delaying saving for retirement. At the end of the day, I think everyone is more or less a bit lazy and likes to procrastinate, especially deep down. One of the most important factors determining how much you can save by retirement is not actually how much money you earn. It is how early you start saving. This is one of the most powerful charts in the entire field of personal finance. It shows the advantage of saving early. Now look at what a difference it makes. If you save $1,000 a year and get a 7% annual return, starting at age 25 as shown by the blue line here, or starting at age 35. Of course, on our channel, everyone's goal is definitely more than saving $1,000 a year, but just to illustrate how big the gap brought by starting early is, you can see that a person who starts saving at 35 ends up with a total that is basically only half of what a person who starts at 25 gets. If you did start a bit late, I think it is okay because the best time to invest was probably yesterday, but the second best time is right now, which is today. Here's a great summary of the ninth trap and how to avoid it. The first step is to save money. The second step is to stay away from debt. And the third step is to live below your means. And the following fourth point is the core key to financial success. That is directly save at least half of every raise. This means when your salary increases, you should use at least half of the increase for your retirement savings. This can be said to be a financial rule that is easy to follow and highly beneficial no matter how much your salary increases in the future. The 10th trap is severely insufficient insurance coverage. If you are watching this video, you are likely already on the road to accumulating wealth. But one way to keep that wealth is to ensure from the beginning that you will not lose it. As your net worth grows, your insurance needs will also increase, your house will appreciate, and you own more assets that could become targets for litigation or robbery. When mentioning your assets, you must remember to frequently re-verify the declared value of your assets with the insurance company. This way, you can always know how much insurance you are eligible to buy in case an accident occurs. Graham Stephan has a habit of checking insurance on Valentine's Day. While this does not sound romantic, the theme of Valentine's Day is taking care of loved ones, so ensuring that family and assets are fully protected on the 14th of February is actually a very meaningful and warm reminder. Although it does not have to be on the 14th of February, I think this is Graham's interpretation of love, and I appreciate it very much. All in all, please make sure your insurance coverage can fully cover the true value of the assets under your name. If you found this video helpful, welcome to click and watch the deep analysis video on wealth growth in 2026 in the upper right corner. Welcome to share the biggest financial trap you have stepped into in the comments section. I really want to hear your stories. See you in the next video. Remember to follow our updates. Goodbye. Thanks for watching. Take care.